Hi, welcome to Chapter 14, Long-Term Liabilities. So we talked in Chapter 13 about how companies can raise capital by issuing stock. There's advantages and disadvantages to using stock transactions to increase your equity or your capital that you need to do fund large projects. However, there is also another option, and that is to fund long-term liabilities. Issue long-term liability, not fund it. So let's talk about bonds and notes. Okay. So we are definitely going to go through the slides and cover everything that I feel is important, but there's a lot about this stuff that I am not going to expose you to. This is your second accounting class. Um, I feel like there are a lot of concepts here that I wasn't even exposed to until I was in upper level accounting classes, and I don't want to confuse you, and I don't want this to become something that's a frustrating thing, and it can be. So I'm not going to cover some of the stuff. So if you're following along with slides on your slides, I will be skipping some occasionally, all right? So just be advised on that. Bond financing, all right? Basically what happens is a corporation will issue bonds. Investors will purchase the bonds, and whatever the amount is, the face value or the par value, is going to be multiplied by the interest rate, and they're going to receive that semi-annually for the life of the bond until the end of the life of the bond, and then they're going to get their full amount back. That's kind of what a bond is. It's a difference between a bond and a note. Is that a note? Well, I'll get to the difference there, and I'm sure there's a slide there. If not, I will cover it. But let's look at the advantages and disadvantages of bonds. So instead of issuing stock, if we issue bonds, it's not going to impact who controls the company. The interest on bonds is tax deductible, and bonds can increase the return on equity, but bonds can decrease the return on equity as well. And the disadvantage too is that bonds require payment of both periodic interest and the par value at maturity. So there is some disadvantages there. When you issue stock, you don't have to pay anybody back. When you issue bonds, you have a liability that you have to pay off every month, every year, every 6 months, whatever. And here's what a bond looks like. This one is for the Minnesota Vikings, and yeah, it looks pretty cute. Whatever. So whenever you see something like this in bond trading, it says IBM here is close. The bond is at 103.08. What that means is that it's being sold above its par value. It's being sold at 103.808% of its face value. And what that means is that whatever rate was offered on the bond is better than what the market is giving right now. And so that's why it's selling at a higher rate. So let's talk about accounting for par value bonds or par bonds. So in this situation on December 31st, 2021, a company issued the following bonds. Par value is 100,000, stated rate is 8%, interest rates June 30th and December 31st, and the maturity date is in 2 years. Whenever a company issues bonds, it's really simple. They're going to debit cash and credit bonds payable. It's really that simple. That's all we're doing. Now, bonds, unless stated otherwise, pay interest semi-annually. So we're going to have to take the $100,000 times the par value or the percentage on the stated rate on the coupon or whatever, 100,000 times 8%. And we're going to divide that by 2 or multiply it by 0.5, whatever you'd like to do. And that's going to come up with your amount of expense every 6 months. In this case, 100,000 times 8% times 0.5 is going to give you $4,000. Every 6 months, we're going to pay this amount to our investors, basically. So on when the maturity time hits on December 31st, 2023, what this doesn't reflect is it doesn't reflect that we have to still make our final interest payment. So on December 31st, 2023, we'll make the final $4,000 interest payment, and then we're going to pay back the bonds there at 100,000. Now, just like I showed you at the beginning part of this with IBM, it was selling at 103.08%. What that means is it's selling that the contract rate on the bond was higher than the market rate. So when you look at this chart here, you know that it was selling at a premium. If the contract rate and the market rate are equal, the bond sells at par. But if the contract rate is less than market rate, the bond sells at discount. So you're thinking, Brian, why would you have a contract rate less than the market rate? If why wouldn't you just issue it at market rate and then you're good? Well, bonds don't get created overnight. When a company wants to issue bonds, they have to go through a process to do the issuance. The board of directors agrees to a certain percentage based on financial conditions, but whether you're aware or not, bond or market rate percentages fluctuate daily, minutely, hourly. They're constantly changing. So when a company issues these bonds, the market rate could have increased or decreased at that time. And at some point, maybe it's even equal to whatever's on the contract rate. But either way, um, we have to account for when the company sells them. At that point, the company's going to experience whether we've sold it at a premium or a discount. And all the premium and discount does is marry the bond percentage up to the market rate or down to the market rate, whatever it is. Okay. So that's what that means. So how do we account for bonds we sell at a discount? So first of all, when you see a bond selling at something other than 1%, or excuse me, 100% of par value, that means it's at a discount. So what that means here, if you see my cursor here, 96.4% of par value, that means it's under 100% or 100% of par value. If it's under 100%, it is at a discount. Another way to tell is if your stated rate is lower than market rate. If your stated rate's lower than market rate, you're selling it at a discount. So here's all the other information that you're going to need. It's 2 years. It's basically the same bond we just dealt with on the prior slides. So we know we're selling at a discount. So what we're going to do is we're going to multiply that $100,000 par value by that percentage it's selling at. It said it was selling at 96.4. So we're going to sell it, or we're going to cash the cash amount of whatever the par value is times 0.964. In this case, it's going to be $96,400. So the remaining amount's going to be a discount on the bond. Well, if we're going to get cash of $96,400, but our bonds payable is going to be a liability of $100,000, well, we have a discount on bonds payable, which is a contra liability account that's going to be $3,600. That's where the discount comes into. Here is our carrying value. Guys, this is kind of like our long-term assets, all right? Think of bonds payable as what you paid for on the asset. Think of the discounts on bonds payable as kind of an accumulated depreciation. Although it doesn't act like that, that's how we reflect it on the balance sheet, okay? It's not that we're going to accumulate. This number's not getting bigger. In fact, this number, this bond's discount or premium will always get smaller until it gets to zero, okay? So that's kind of how that works. But what I don't want you to worry about is the amortization, okay? It's showing you a little bit about the amortization over here. Don't worry about that. I'm not going to hold you to that. Just worry about how much the bond interest expenses and the cash is going to be, okay? But just know that we're going to be taking some of that out of the discount on bonds payable. Accounting for bonds premium, all right? Same thing, just the other way now. It's issued at higher than 100%, in this case 103.6, and the stated rate is higher than the market rate. Everything else is going to be the same. Instead of a discount, we're going to have a premium, and we're going to have what's called an adjunct liability account. So basically, it's not a liability per se, but it coincides with a liability account. And this $3,600 is going to be held as a premium, and it acts very similar to the discount, except it's going to be on in our favor. Basically, we're getting more money now than the bond would have originally given to us. It's basically us taking advantage of the higher market rate. And then we have our journal entry here. Don't worry about it again as far as the discount. Well, at some point, we're going to retire our bonds. We can do this a number of ways. We can either cash them out, basically buy them back, give the money, the amount of money that's owed to the bond holder, or we can reissue bonds, or we can convert them to stock. There's all these different options that we can do. But what we are going to focus on right now is the cash. We're going to debit our bonds payable and credit cash. We're done. The amortization or the premium or discount is fully amortized at this point, so there's no worry or concern about that. If we retire them before the maturity, if our carrying value is greater than our retirement price, we're going to have a gain on our bonds retirement. If our carrying value is less than our retirement price, we're going to have a loss on bond retirement. So in this case, we're assuming that our $100,000 of callable bonds will be retired on July 1st after the first interest payment. The bond carrying value is $104,500, and we have a call premium of $3,000. So what that call value is means we got to pay that $3,000 to call them. It gives the investor assurance that if we call them in a time that's going to reflect good for the company and not so good for the investor, that they get something out of it. So we're going to get rid of our bond payable and the premium. As you see, there is a debit because normally those are going to be credits. We're going to get cash, or we're going to pay cash, excuse me, of $103,000. The remaining amount, if it needs a credit, it's going to be a gain. If it needs a debit, it'll be a loss. Now let's look and see. Oh, I thought we were going to go into a loss. But anyway, all right. So now this is the one that I really like to focus on in this chapter, in this course, is long-term notes payable. This is something you're familiar with. If you have ever had a car payment, a personal loan, you'll know about it about student loans if you are having those at some point, home loans. This is the type of loan we typically get. What happens is that when we have our note, when a company issues a note, the lender is going to give us the money, and we are going to not just make principal payment, or excuse me, interest payments. We're going to pay principal and interest on whatever it is we're doing here. So they're called installment notes because we make basically installment payments to the company or the investor, whoever's loaned us the money. All right. So on January 1st, 2021, the company borrows $60,000 from the bank, signs an 8% installment note. Recording the receipt of the note is similar to the bonds. We're debiting cash, crediting notes payable. Instead of bonds payable, it's notes payable. 8% 3-year bond. Notes. Okay. This is a amortization schedule for a note, okay? You're going to be creating one of these for one of the assignments in this course. So become very familiar with this, okay? What we have is our beginning balance. Our interest expense was 8%, so we're going to take 8% times that 60,000. That's going to be our interest expense. We're going to compute our cash payment, and I will show you how to do that at another time. Well, it's actually using the present value interest factor. I see that it's down here. We look up, this is a 3-year note with 8%. So you're going to go to the present value interest factor table of an annuity and look up the 8% across the top and find 3 periods down, and it's going to give you this factor 2.5771. And you're going to take the 60,000 divided by that factor. And that's going to be your payment. So you can take your payment, subtract out the interest, the remaining amount's going to go to your notes payable, and then you're going to have your ending balance. And then you do it all over again. Interest on that beginning balance, subtract that out of your interest, and you're going to get your thing until you get to 0. If you don't get to 0, that's because you did it wrong. Here's our journal entries, and you can do it. See here, with this table here, you can do your journal entries every time. Every time your credit's going to be to cash. Every single time, without fail. Same amount. Your payment will not change. But your debit to your notes payable and interest expense will change, but it will equal the payment. So with that, you can see here in 2001 or 2021, 22, and 23, our journal entries are the same using the same accounts. It's just that the interest expense and the note payable amount changes each year because you're paying off a little bit more every year. Mortgages are an example of one of these, and I've already told you that. So that is how we'll do it. And I'm going to be doing a snippet video on how to create one of those amortization. I keep calling them amortization schedules. They're not amortization, but you know what I mean. Basically showing you how to discount all that stuff. Analyze the debt to equity ratio and assess debt features. This is important, especially for your end of the semester project that you're going to be working on and knowing how to do this, okay? So what we're doing for our debt to equity ratio is we're taking our total liabilities, dividing by our total equity. And there is no necessarily a fast number that is the absolute correct. It really depends on the industry. Depends on other companies. But think of it this way. The more equity you have, more likely the better off you are, right? The more equity you have, you're going to have more equity less liabilities, that's a good thing. But if you have too much equity and not enough liabilities, you might be a target for a hostile takeover. So there's this weighted average cost of capital that a lot of people try and it really is an art, and it's one of the things that people like to argue over the years. The bottom line is this is there really is no fast answer to this, and so it's really just a matter of what do you think is good for the company? What do you think is good for the industry? So I like this one because it leaves a lot of interpretation, and I love to hear students' ideas on it, stuff like that. So if you're following along in the chapter spread slides, you're gonna realize that we just skipped a lot. Okay, it's because I'm not going into how to amortize the bond discount. There's the straight line method. There's other methods. I'm just not going to get into them, guys. It is quite convoluted. So, all right. Chapter 14. Your word is Angela. 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 You guys, if you have any questions, let me know. Let's get together. Shoot me an email, text me, talk to me in class, whatever your circumstances are. But let's get together and figure this out. If you have any questions, don't put off your assignments. Get them turned in, get them done today, and stay on top of things. All right, we'll see you guys in the next videos.